Hello, all traders and everyone watching. My name is David Kinley, and this is the free live webinar to the introduction of financial markets. Now, I just want to start by saying this is the first in a series of webinars that we will be conducting every Monday just to get people more familiarized with the financial markets in general. And going on, we're going to go to from beginner to intermediate and to more advanced webinars. But just for today, I just want to start by going back to basics. A lot of people always ask me basic questions, and some are quite afraid to sometimes ask me what is required to start trading, what to look for in the markets. And some people are a little bit apprehensive or shy to ask about the basics of Forex trading and trading in general, CFDs, especially what Orbex offer with commodities, shares, indices, just to name a few of the instruments that we offer. So with that being said, let's get straight into it. As I said, my name is David Kinley, and I'll be going through this free live webinar. So let's just go on to the next slide. So I just got a nice little bit of imagery there. Just go into the next slides as we go on. So what does the market actually mean? So basically, the market is a place where traders buy and sell different instruments, and that can be different asset types as well, such as I said before, Forex pairs, commodities, indices, etc. Economists refer to it as a mechanism between the buyer and seller of different types of products, and buyers and sellers want to make profits from their decisions. And the good thing about buying and selling CFDs, it's not the same as if you're buying something on a exchange where if you buy, you make money, and if you sell, you lose money. With CFD trading, if you buy and sell, there are opportunities to increase your profits vastly. Let's just take a look at the financial markets. On the other hand, is a place where the buyer and seller conducting these transactions on financial assets look to make profits on price differences. So let me just pull up the MT4 platform just quickly. So we'll be looking at the MT4 platform a little bit during the course of this presentation, because I just want to take you through some examples just to make things a little bit more clear, and obviously to make sure that you're not missing anything. So like I said here, we've got all the asset class for Forex pairs here. I'm on my Orbex demo account at the moment, so it's a lot easier just to show you quickly what I'm talking about. These are all the shares. So we offer shares in the American market and the European market and the UK market as well. And if we just keep going down, we've also got the US indices as well as platinum, palladium, and gold and silver there as well, with the UK and NGAS. UK Brent oil and WTI crude oil as well. So just want to, we'll be looking at the MT4 platform as we go, though, just to give you the examples as I go through them as well. So more nice little imagery there. So the types of financial markets that we're going to go through today. So we've got monetary markets, also known as money markets to some investors and traders, Forex, which we'll be looking at, commodities, bonds, and equities. So monetary markets, we can be looking at these markets as types of, it's basically, the government has quite a big influence in these monetary markets, because, when it's the interest rates, inflation, tapering, these kind of subjects, which we will be looking at in further webinars as we go along, we see that the government, when they start tightening monetary policies, or if they start giving out new or higher fresh interest rates or inflation rates, it does affect the economy in general. So let's just take a quick example. Recently, the Bank of England increased its base rate from 0.25 to 0.50, and this was to calm down the level of inflation that is kind of spiraling out of control in a lot of countries due to the COVID pandemic at the moment. So in normal, simple terms, if the cost of borrowing rises, consumers and businesses have less money to spend, basically. So if you have to, if borrowing for a company becomes too expensive, then naturally less people are going to do it. Demand for goods and services will then fall, and in theory, so should prices. And that's why increasing the bank rate, like the Bank of England did last week, is kind of like a signal for a slowing down in inflation. So higher interest basically mean borrowers would need to pay more for the loans they get, and the same for any person in the world. If you have more higher interest rates, then borrowers would need to pay more for the loans they get. So if you want to start a business, for example, or take out a loan to buy a car or do anything of that sort, then your borrowing costs will be higher this time next year. So with that being said, always keep an eye on what the government and the central banks are doing with these markets. Foreign exchange, we'll take a look at soon, but Forex is mainly driven on how strong a economy can be. So the biggest economies in the world are obviously, the American ones, the European ones, and the Asian ones, and the Pan-Asian as well. So we'll take a look at what big currencies we are looking at shortly. Commodities, this falls in a few brackets. Commodities can be gold and oil, amongst other vast instruments. Bonds as well. Bonds are quite interesting because government bonds or big finance institutions usually provide bonds. They're not as risky as other options, but they do have some good things and bad things to them. Bonds are basically units of corporate debt issued by companies, and they can be tradable as well, but they have to be paid back at a certain time. Again, we're not going to go through this too in depth because I want to just get the basics of trading out of the way before we move on to our other webinars that go into a bit more advanced details. And also, you have a say in that as well. Any topics of discussion that you would like to go over on webinars, then feel free to send us a message, and we'll be sure to cater for that as well. Equities as well, we look at equities and indices in general on the scope of how an economy is pushing. The basic concept of an equity is like an investment in companies. Companies then pay back dividends to their clients or to the shareholders. But however, if the company does unfortunately come into a bad time, if it does liquidate, go insolvent, bankrupt, whatever you want to call it, then it will lose, the shareholder will lose funds, or the trader will lose funds, and then no dividends will be paid out as well. But we'll go into that, as I said, in more detail as we progress with the webinars and as we go on. So the Forex market in general, Forex is abbreviation of foreign exchange, which means trading different foreign currencies. So the major markets that investors trade with are US dollar, Japanese yen, British pound, to name a few. We've got obviously the European euro, the Australian dollar, and the New Zealand dollar, just to name a few. The Forex market operates 24 hours a day, 5 days a week, with Saturday, Sunday being the weekend, and that is when the market is closed. There is after hours trading. I have to kind of stress this. So when there are economies that are closed for the day, which we'll look at the times shortly, but say the US market is closed, there is after hours trading where unfortunately traders can't trade CFDs at this time. And when the market does open, there could be big gaps in the market if there is if things have happened during these after hours trading during the middle of the night when people are not trading. So we'll look at that shortly. That's just something to stress, that the market can still move even if it is closed. The Forex market is the biggest and most liquid market in the world, with a daily turnover of $5 trillion, and that is actually rising on a daily scale. If we look at the next slide here, so total Forex, for example, this is in value in billions. If you just take a look at the concept here, the contrast, so you've got the New York Stock Exchange and the NASDAQ, for example, two big players in the market that a lot of traders and investors trade on. If you look at how much Forex is traded compared to these two markets, you just get a general idea of how big the foreign exchange market actually is. So very, very significant there as well. So just take in mind that Forex is a very, very large chunk of what traders go for in the general market anyway. So Forex market sessions. So we have four main times of the day. So we've got the Australian, Asian, European, and American session. This is all GMT +2 time at the moment. Obviously in the summertime, when the daylight savings time does change, it does go forward 1 hour. But at the moment, we're seeing for traders and investors, the biggest trading time of the day with the most liquid market are the European and American sessions. When the European crosses to the American session, roughly when these two cross over. So roughly about 1 o'clock in the European session, and that's the 1 o'clock in the American session, when they trade over, we get the most liquidity in the market. Now, what is liquidity? If I take you back to the MT4 platform, we've got a simple euro dollar chart at the moment. Euro dollar is one of the most popular Forex pair in the market at the moment. And what we're seeing here, I've got it on a 30-minute chart, but if I break it down to a 1-minute chart and just see, I'll just zoom out a little bit. So you can see here, 1 minute, we've got a few small gaps emerging. I'll just move it to the end though. This is where we currently are at the moment. So as the American session is underway, you can't see too many small gaps in the market. Every time a candlestick has opened and closed, we're seeing that there's not many big gaps in the market. Now, what is a candlestick in general? We're going to go through this, as I say, in another webinar, but I'll just give you a brief outlook. So we've got here the body of the candle here. So we've got the high and the low, which is the two peaks that we've seen here, and we've got the open and the close. If you just hover over there's two ways to see the prices here. If you hover in the bottom right corner, you can see all the details here: open, high, low, close, and the volume. Or if you're a little bit impatient and you can't get that bottom right corner, if you hover over the candlestick in general, down here, I've just moved it, but down here in the bottom right hand corner, you can see the details as well. So O for open, H for high, L for low, C for close, and V for volume. So as you can see here, we're not seeing, when every candlestick closes, you can see that it is pretty much a full body candle, and there is a candlestick here. But as we go, and this is currently at 2:30 today, but as we go into the early session, the early Asian session, so this is when the market is opening in Europe, but as we go back, you can see more and more gaps happening, because this is to do with the fact that there's not many traders in the market, and in turn, that means that there's not many prices in the market at that time. So there's a lot of volatility, because as you can see here, we've got to just before 2 o'clock, excuse me, 2 o'clock in the morning. And just when the rollover time happens, which is at midnight, you can see that there's less and less pricing. And this is due to the fact that there's not much activity in the market. And when there's not much activity in the market, it means there's less pricing in the market. And this is just a natural thing in the market. It just means that there's less people trading around these times. And as you can see here, it's just after midnight, and this is what we call the rollover time. So we go from one price to another, because the rollover gives us a term, excuse me, it gives us an idea of what's going to happen for the next day. So more importantly, this is the weekend gap as well. So we've closed here on the 4th of February. Today is the 7th of February. And as you can see here, there is a gap. And now the gap has been caused by the after hours trading and the news events that's happened over the weekend. So that's why when we see a Monday morning, when the market does open, we see a gap in the market. And in doing so, we get these kind of price actions. But as you can see, very limited, very choppy pricing at the moment. But as we go into the European session, 6 o'clock in the morning, 7 o'clock, 8, 9. As we go to the European and UK session, you can see these larger candlesticks, and also more volatility, more price action, and more participants in the market. So this is something to consider when you are thinking to trade, when you are putting trades in the market, not to get any unnecessary pricing that you don't want. So I just wanted to show you that, just so that you're aware. As I said, we're going back to basics here with everything that we're doing, and we're just making sure that we're clear on everything. So back to the Forex market sessions as well. So as you can see, Australian sessions, Asian, European session, American session, these are all the approximate times when we're seeing these markets open, and in doing so, more and more liquidity in the market as well. So advantages of trading CFDs in FX markets. So like I said before, you can buy or sell. Buying and selling, even if the market falls down and you're in a sell position, you can still gain profits. So let's go back to the MT4 platform just really quickly. So if you opened a sell position here, for example, and the market did start moving lower, you would be in a position of profit. So as you can see here, this fell roughly about 30 pips earlier in today's session, and a trader that was selling or is short would be able to actually benefit from this downturn here. On the other hand, if someone put in a buy position here, and obviously the market did not go higher, then they would be in a loss. Conversely, if they put in a buy position here, they would obviously be in the running for a nice profit, because the market did go in their favor as well. So just a few things to look out for in that in those options there. So low spreads will go into detail shortly, and leverage as well. 24 hours a day, 5 days a week trading opportunities, very transparent market. You know, there's no hiding any of the orders or any of the opportunities that are in the market, and also instant market orders as well. So as soon as you hit that button, the price will open, and then you'll be able to see what the buy or sell price is. So just moving on. I hope you like the presentation so far and the design. What are the traded currencies? So the major currencies at the moment. So we've got dollar, euro, Japanese yen, British pound, and Swiss franc. These are what you could call the most popular for a lot of traders and investors. It's because there is probably more news coming out on a daily basis with the US dollar and the euro, and also the yen, the British pound, and the Swiss franc as well. So we're seeing a lot more in that, basically a lot more things going on and being traded. If you look at our trading calendar, our fundamental trading calendar on our website, you'll be able to see what the major movers are in a given session. And with that being said, the dollar, euro, and UK pound is something that we always we look at more often. And just seeing what the minor currencies are. That these are just to name a few, but there's a few more. You know, Canadian dollar, Australian dollar, New Zealand dollar, Danish krona, and Mexican peso. You know, the American dollar against the Canadian dollar. I'll just bring you back to the MT4 screen at the moment. As you can see here, dollar against Canadian dollar. This always goes back to back because the countries are so close to each other. It does affect the currencies do affect each other quite vastly in that sense. And you know, we're seeing at the moment when there is Canadian news as well as the American news, such as when the non-farm payrolls were out on Friday, there's usually Canadian news at the exact same time. So it is something to look out for when you are trading these pairs as well. So let's take, for example, this was when the NFP was released, and it was actually quite detrimental for the Canadian dollar and quite beneficial for the American dollar. So with the good American dollar news, because the NFP had very good job numbers, we saw a push on the pair because the American dollar was the base currency and the Canadian dollar was the quote currency. And we'll go through that shortly. But as I said, because it was a good move, we got a nearly 70 pip move. And that was very, very significant in that respect as well. So these are just things to look out for. So currencies in pairs. So Orbex trades with currency pairs, not individual pairs. So it's always base and quote currencies. So going back to the MT4 platform again, base quote. So euro dollar, pound dollar. So if there was news coming out that was very, very buoyant for the American dollar, any pairs such as dollar yen, dollar Swiss franc, dollar CAD, if it was beneficial for dollar, these pairs would move higher because they're against another pair. Conversely, we're looking at euro dollar. If go back to the 30-minute chart here, if it was bad news for the American dollar, we would see prices start moving lower. So this was the NFP time here, 3:30 on Friday. As you can see here, we had a bit of bad news good news for the dollar. So conversely, euro dollar went down by 50 pips. It did recover after a few hours. However, at the particular time that the news came out, as you can see, the market moved lower. So let's just put the two, charts together. So we've got Canadian dollar and euro dollar. So as you can see here, when both sets of news was released for the NFP, we got this very detrimental move to the downside because it was a strong dollar. It was a good dollar news. So that's why the prices went vastly lower. Conversely, on the other hand, we did see a move higher for the dollar at the same time. So you just look out for the trends in different markets. And what do I mean by that? Well, as you can see, a very, very sharp move to the upside for dollar yen because it was a good dollar move. So dollar progressed and the Japanese yen fell. And looking at, let's see, the US index as well, at the time, we saw a move to the upside. I'll just put it on a 30-minute. US index was a little bit choppy, but you get the general idea. When there is a move to the upside for dollar, you'll see that this is a UK pound against the dollar. You'll see that prices are moving in the other direction. Same with this as well. When the news was released for the NFP at 3:30, we saw a move lower because there was a strong dollar. So because the pound is the main currency here, for the pound to go down, meaning that the US dollar actually gained an advantage. So just a few things to look out for as well. Now let's go back to the presentation quickly. Oh, one slide. Okay. So pair categorization, so direct pairs, like I just said, we're looking at dollar being the counter currency or the quote currency. So euro dollar, pound dollar, Aussie dollar, and New Zealand dollar, also known as Kiwi dollar, or the Kiwi. So we're looking at dollar, 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 and here is where the dollar is the main driver, is the base currency. Cross currencies, on the other hand, that don't involve the dollar, there are some examples here. However, don't be fooled that the American dollar cannot influence these other currencies as well. When they are, even if the American dollar isn't involved in this symbol or this currency pair, it can still affect the direction of the pair anyway. So just keep a lookout for that when you are trading these ones, these cross currencies as well, because they can actually lead to moves in the market that involve these currencies as well. So as you can see here, dollar CAD, if you're trading Aussie CAD, if this has a very sharp move, then it's going to affect this, for example. Same with pound dollar, pound yen. If there is a very big move on the pound dollar, it will affect the pound yen as well. And buy is a long position and sell is a short position. So basically, if you see a bull market, and a bull market means when the market is rallying to the upside, you do expect it to move higher. You can execute a buy order on that pair, which means you can buy the base currency and sell the counterpart currency. So another very important thing there, if we're going on a euro dollar trade, when you buy that trade, you're buying the currency of the euro and selling the currency of the dollar, so in units as well. And we'll take a look at what these units are shortly. Conversely, selling and shorting, if you think the market is in a bear condition or you expect that the pair will go lower, then a sell order on that pair will be executed, which means that you short the base currency, you sell the base currency and go long on the other currency as well. Excuse me. So that's basically what long and short means, nothing too much to it. Now, a pip is basically percentage in points, and what does it mean exactly? So let's just take the example I've given here. So euros, dollar Swiss, sorry. If the price changed from not 9300 to 9301, it means the pair has gone up by a pip. The pip is the fourth decimal in the currency pair, apart from any Japanese yen pairs. So moreover, we'll check that in a second. If the quote of the pound dollar has moved from 132.50 to 132.40, it means that the pair has declined by 10 pips. So this would be 1 pip. 10 pips here would be, so it'll be 50 pips. And then we've got, this is the next in line, so this will be 100 pips. So if the market moves up from 132.50 to 133.50, then there has been 100 pip move in that order. So let's just go back to the MT4 platform again, just so that we are 100% clear with everything that we're doing. So back to euro dollar, because it's quite a popular dollar, popular currency pair. Sorry, let's go back to 15-minute chart. So what we're seeing here at the moment, let's go to a daily chart, might be easier. So daily charts is everything that has been moved for the whole day so far. So if I just go to the top of this candlestick here for the current day, and the bottom, we'll go to just under here. So we've got 1.4115 against 146.64. So just to be sure, because the last time I checked, my maths wasn't that great. So 1.14644, put the calculator on the screen for you. And then we're going to minus 1.14150. So we've moved so far today. The pip is the fourth decimal after the fourth figure after the decimal point. So we've moved 49.4 pips so far today. If this was a 0, we would have moved 9.4 pips so far today. And this fifth digit here is actually called the point. So 10 points make a pip, basically. So if this goes up to 10, this will go to 10. Well, it's on a 9 now, so it'll go to 0. And by doing so, this will be on the 5. So not to go into too much confusion, basically, this is the pip amount. This is a point. And at the moment, 49.4 points have been moved so far today. If we look at a weekly chart, so it's Monday today. So let's go back to last week. It's probably not the best example. So let's just take the high of that and the low. I'm doing this just to show you what the high and lows are. As I said, you can just hover over it and see in the bottom right-hand corner, the high was 114.83 and the low was 111.37. So let's just put that onto a chart. So 114.84 minus, what was the low? 111.37. So 111.37. So as you can see here, there's no fifth digit. This is the fourth digit here. So we in a given week, the market moved 347 pips. So that's basically what a pip is. It's just the fourth digit on the currency pair. Excuse me. And apart from Japanese yen pairs, now Japanese yen pairs is the second digit. Because they have less digits on their currency. So after the decimal point here, we're going to go 1, 2, and coincidentally it is 1, 2. So this is the pip amount. So basically the difference between 115.123, 115.146 is 2.3 pips, which is the spread. And again, we'll be going over the spread and other basic things like that in our other webinars. We're just getting you through the basics to make you feel more comfortable and making sure that you are up to date with the basics on fundamental trading. So let's go back to the presentation. So, excuse me. So as I said, if the dollar Swiss price has changed from 93.00 to 93.1, that 1 pip here is the pip that is moved by. And on the second example, we've given a 10 pip move. So 32.50 to 32.40, and it's declined by 10 pips. And again, if we go to 32.30, it would decline by 20 pips. So that's just basically the basic momentum there. Okay, bid and ask. So the market watch on MT4 consists of two prices, bid and ask. These prices here are what depending on your order, one trade will open at the bid and close the ask, and the other trade will close open at the ask and close at the bid. So back to the MT4 platform. So again, I've got a euro dollar. Let's just put this on a 30-minute chart. So what I want to do is just show you. I'm going to open a trade here on my demo account. So at the moment, this is the price line, 1.1429. So this is the price line that we're asking. If I opened a, let me just, I'm getting confused now. So if I open a sell position, my sell position is going to open at the bid line. A sell position basically means that the trade will open at the bid and close at the ask price, and vice versa. If you open a buy, it will open at the ask and sell at the bid. So I want to sell. So I'm going to, the price is going to open at this price here. So 114,213, 114,213. However, when I close it, it's going to close at the ask price. And what is the ask price? Well, that's basically, this is how we get it, by the way. I'll put it on a minute chart so it's easy to see. So this is the ask price. So I need to pay the spread, basically, of the trade. I need to get past the spread. And once I'm past this ask line, when I close the trade, then I'll be in profit. Currently, as you can see, I'm $16 in a minus because of the spread. So once the market starts moving and I move past the ask price, then I'll be able to realize my profit. So this is for a sell position. For a buy position, I'm going to open at the ask price and close at the bid. So because it's a demo account, I'm not really too bothered about my my losses there. I just want to show you the examples that I'm going through at the moment. So now we have a buy market. So with a buy, I'm going to open at the ask price, 115.22 approximately, which is here. So there, well, 114.22.9. So that's where my trade opened. And in order for me to make a profit, I need the price to close past the bid line. So I need this bid line to push up past where I opened my trade just now, which is the green dotted line. So just bear in mind that even if you open a buy and a sell position at the same time, due to the spread, you won't be in a profit until you move past that particular line. And in doing so, then you will realize the potential profits. So it's really, really important to understand that in doing so, you are looking now at the fact that you are hovering around the same price that you opened. However, as I said, you need this bid line to go above because you're in a buy position, obviously. The buy position obviously needs to finish in a bull market, which is a upward market for you to make profit, and conversely, a downward market to make profit for, for a sell position. So just to see that one more time, open euro dollar. So sell will open at the bid and close at the ask. So I've opened at the bid line, and then the other way around, a buy will open at the ask and close at the bid. So just to keep that in mind when you are trading and starting out, because when I first started out many years ago, I was opening buy and sell positions to see how quickly profitable I can be, and not understanding that each trade opened in a minus because of the spread and because of the bid and ask procedure that comes with the standard foreign exchange market as well. So yeah, just to get a close up of that, as I said, Japanese yen pairs, euro yen, they only, the second digit after the decimal point is the pip value. And pip values we'll go on to another time. As I said, we're going to have more and more advanced webinars going into the new year as well. And I'll explain them at the end of this presentation. Okay, so volume now. So you execute the buy and sell positions in the Forex market by standardized volume size called lots. So what I was doing on my demo account trade was opening a one lot, which is 100,000 units of that base currency. A mini lot is 10,000 and a micro lot is 1,000. So also known as 0.1 and 0.01. So going back to the MT4 platform, as you can see here, if you click on here, we can go right down to a micro lot 0.01, or we can type it in manually. That's a mini lot 0.10, or we can go, 0.12, 0.14, we can go as low as 0.01, which is a micro lot. So again, with that being said, that will affect your margin and your free margin as well, but we're going to go on to that in a different time. The next webinar that I'm doing is the calculations of Forex, which will go through everything about calculating everything that you see on an MT4 platform, and even before it as well. Okay, so with that being said, let's just take a look at leverage as well. Just going to briefly skim across leverage because there is a lot more to leverage than just a small PowerPoint slide, and as I said, we'll go over the calculations in the next webinar. So leverage is one of the reasons markets become available to the retail traders. It's a tool that allows traders to take big positions with little margin, which increases the risk and opportunities to the investor. So type of leverage you might see on a daily trading basis, 1 to 30 up to 1 to 500. So an example, one lot of euro dollar at 116 with a 130 leverage. The calculation is, so what I said on the last slide, one lot is 100,000 notional value times the rate and divided by the leverage. So that's how much margin we need. So based on the margins that we offer, if you wanted a 1 to 500 leverage, which is the biggest leverage that we offer, so 100,000 times 1.16, and then divided that by 500. So as you can see here, you need a lot less margin, a lot less balance in your account to open that trade. However, the seesaw or whipsaw effect of leverage can actually put you a little bit more at risk, because the old saying goes, the higher the leverage, the higher the risk. But we'll take a look at that in another webinar. I just wanted to give you a brief example of what leverage is and how it is calculated. So basically, if you had a one-to-one leverage, you would have to actually open 100,000. You would need $100,000 to open 100,000 notional value, or whatever the currency rate would be. So it'd be 100,000 times the rate, and that's how much money you would need. So leverage offers the opportunity for traders and investors to basically take on these trades, but not to put so much money or their margin into the trade itself. Let's just a quick look at leverage again. So leverage, if we look at step by step, the trader takes position in the market by any volume they desire. So like we said, volume being one lot, standardized lot, 100,000 units, or mini lot, micro lot. The broker allows the taker to trade the position. However, it takes the margin for that volume. And then after the trader closed the position, the brokerage returns to them that margin, and then adds or subtracts the profits or loss accrued. So what I've done here, I'll just show you my account history for today. Custom period, let's just do today on the trades that I've done. So the trades that I've just done live with you now. So, I've made a loss of $121 because I was just opening and closing trades, just for examples. With that money, I've automatically been reduced from my balance. So before this, I had close to $6,000. Now I'm on $5,816. So that's an automatic move. Once the trade has been closed, the broker, Orbex itself, will calculate automatically your profit or loss on those trades. So just so that you're not missing anything as well. And just to cap off the leverage conversation, so imagine your account balance is $1,000. If your leverage is 1 to 100, you decide to buy dollar yen with 0.1. So that 0.1 means the mini lot, sorry, so $10,000. So as I said before, whatever the base currency is, that's what you're buying, that's what you've got. So you're trading on $10,000 against Japanese yen. And after the position is closed, the margin will be returned as well. So as I said, we'll go into this a lot more detail as the webinars go on, and we'll see a lot more of this. And just going into the final moments of the presentation, I just want to take you through orders. So there are two types of orders, pending and market orders. Now, what I want to look at the moment is if we're looking at, sorry, I had my other presentation open there. So if we're looking at pending orders, we've got the market orders are basically the instant orders that when you go to, let's go back to the MT4 platform. When we go into here, we open a trade, buy or sell. That's the market order. It's market execution, and the order is opened in the market. If we go to pending orders, we've got 4 types of pending orders, which I'll just show you. So we've got buy stop, sell stops, and buy limits and sell limits. So basically we've got 2 types of stops and 2 types of limit orders as well. Now, what is the difference? Well, stop orders basically mean that you are, if it's a buy stop, then the pending order is set above the market price. A sell stop means it's below the market price. And what do I mean by that? So let's just go out of here. So a buy stop can never be set below what the market is here because it's a buy pending order. Let me just get rid of the ask line because it might be a bit confusing. So a buy stop can only be executed above the actual market price at the moment. So the way it works is I'm going to put a pending order at 114.27 because I believe the market is going to move higher. So from here to here, I believe the market is going to move. And then once the price of the market has hit my pending order, then the market order will open automatically. I don't need to be on my MT4 platform for that. I don't even need to have the MT4 platform open. I just need to set it on my account, and then I'll be able to understand that because it's hit this price, my order will be opened. Conversely, a sell stop needs to be placed below the market price. So I believe that, for argument's sake, I think the market will drop to, let's say, 114, because it's a nice psychological area. 114 round. No, it's down there roughly. So I think it's sort of fall to here. So I'm going to put a sell stop position in because I think that it's going to hit there. And once it does, my order will open, and then I'll be able to move that. Well, that will be able to go into that price, excuse me, and the order will be open. So that's what a buy stop and a sell stop is. A buy stop, basically, just to go back to it, it means that the order needs to be above the current market price because it's a buy trade, and conversely, a sell position needs to be opened below. So let's just take a look now. So I want to do a pending order. Let's just go to the stops. So a buy stop. So the current price is 114.217. 114.22 now. So let's go 114.22. So here's very important. The open price you must must differ from the market price by at least 5 points. This means that currently it's 142.22. It's a buy position as well, so it's going to open at the ask price. Now let's put the ask price back on here so we can see. So the ask price So back to buy stop. So the ask price is at 114.24. 114.24, let's say. So that needs to be 5 points above 114.24. So we need to go to at least 114.23. So it's saying invalid. It's because the market's moving now and I'm very close to the price. So let's just go a little bit higher and it's still invalid. So we need to go a little bit higher than that then. And we're still getting invalid. So it basically means that we need to go higher because this price is moving, and we need to make sure that we are far away from the market. And there we go. So we're above 5 points. It is a valid price because of the spread. This is why we have to have a bit of a gap between the open and the close. And remember, for a buy position, we open at the ask. We're not looking at the bid. That's for a sell position. Conversely, back to pending orders, because we know that the buy stop needs to be above the market price because it's a buy position, we can never have it below. So if you put in, for example, 113, it will always be invalid because it's below the market price. Even 114, I've actually just gone out of it, but you get the idea. We cannot never have a buy stop above, and conversely, we can never have a sell stop. So a buy stop below or sell stop above. So currently, you can go up to 115, for example, for a sell stop. It will never take it because it's above the market price. So conversely, we want to put a sell stop in. So we need to be 5 points away. We're at the bid now. So let's see, 114. If we go 114 round, we should have a nice gap there. So, and you can actually move it if you can just drag and drop it onto, I believe this still works, so it might have actually been updated. See, you can actually click it and then move your pending order a little bit. So as the market's moving, if the market starts moving a little bit, you can still change your mind. And this is an easier way to change it, or you can just click on the actual order itself to delete it or modify it in that way. But always remember, if you're getting an invalid stop loss or take profit signal, then that is the reason. You're not far enough away, or you could be, let's just move that. You could actually be in the wrong side of the trades. Like I said, sell stop, if we go above the market, it'll always be invalid stop loss or take profit because we are not able to move it too much. Okay, so those are the stop orders. So let's just delete them just so it's easier to understand. Now, I just want to take you through the limit orders. What are limit orders? Limit orders are basically on the opposite side of the trade. So what that means is a buy limit means that you suspect the market will fall down, but there'll be a limit. So you think the market's going to go probably, let's just say, for example, to this previous low here, we've got a few lows of good support levels here, and you think that it's going to hit those support levels again and then move higher. So in that case, you're going to have a limit of 114.16, and then the order is going to open, and then you expect the market to move higher, and that's a buy limit. So you expect that the market will hit a slight low. Once it's done that, the order will open, and then you'll expect the market to start moving higher. That's the limit, basically. This is the limit that you think the trade needs to be opened at, and then it will buy. Conversely, a sell limit is made above the market price. So it's a bit of the opposite of the stops. Whereas before the stops, we couldn't put a buy stop below the market and a sell stop higher. With the limits, it's the opposite way around. We can put the sell limit above because we believe it's going to hit, let's say, this recent peak, and then we're going to move lower. So let's just put that into context here. So sell limit And we believe 114.35 is a good limit. And there you go. So I've set that now. And I'm expecting, just move it down. Well, you get the idea, you see where it is. I'll just move that actually so it's easier to see. So we expect the market to move up there. Once it does, the market order will open, and then we will see a move to the downside. And conversely, with a buy limit, we go to the downside and start moving higher. So this is basically the 4 types of pending orders that we look at on a daily basis for our traders. So just to recap, buy stops are basically in following the direction of the trend. So buy stop will be above, say this line here is the bid line, the current market price. A buy stop will be placed here and a sell stop will be placed below it. And conversely, a buy limit will be placed below and a sell limit will be placed above. We won't be able to place a sell limit below the market. So if we go to 114, which is quite far away from the market, it's going to say invalid. Naturally, you would think that a sell position would be below the market, but it's not. So we can't actually, put this sell position in. It has to be above the market price or below. And always remember that we are looking at the fact that the bid and ask line is very, very important. When I first started out in trading, I didn't understand the bid and ask because, we had pending orders, we had trades being closed at certain prices that were not on the chart. So for example, here, if I wanted to open, just close all these. I'll open a micro lot and I'm going to sell because I'm going to open at the bid and close at the ask. When I close the trade, it's going to close me at 114.25. And I didn't understand that because there is no 114.25 price at the moment. The price is here, but it's the ask price. So it's very, very important to understand that even if the price isn't here, if we take the ask price away, it looks a bit strange because there is no price. We've only got the bid price. However, we put that back in and then we're going to be able to see the actual ask price there. So just another informative calculation, let's say, in your trading psychology, your trading plan, as you can say it, and just what is things that you have to just keep in mind when you are trading in general. And as I said, we're going back to basics here, but it's very, very important to know that as we go on and on and on, we are looking to see how we can get on these opportunities and also see what the market is giving us as well for the next few months ahead as well. So let's pull this back on an hourly chart. You can see, let me just go into here again. So as I said, when we're looking at market trends, we look at all the majors. So this is just a few of the majors here: dollar CAD, pound dollar, dollar yen, and euro dollar as well. So as you can see, when a market is trending, I'll put all these on a 30-minute chart so it's easier to see. As you can see, this is when a market is trending, euro dollar. It hasn't really had much movement. We're basically consolidating, not really going too much. Here, we're seeing big moves in the market, big spike upwards on the dollar yen, same with dollar CAD, and similarly with pound dollar. So when one of the major currencies start moving, then the rest of them seem to follow. So it's just something else to keep in mind as well as we go into the trading. So I just want to, in closing the Introduction to Financial Markets webinar, I just want to let you know that I have every Monday for the rest of the month, my other webinars. The next one is Important Calculations in Forex. Then after that, we've got Benefits of Trading Stock CFDs. And then finally, at the end of the month, Money Management and Trading Psychology. So the Important Calculations in Forex, I'll take you more through basically balance equity, margin level, profit and loss, swaps, spreads, pip values, a little bit more in depth, how to calculate how much one pip is based on the currency pair that you're trading on. The benefits of trading stock CFDs is looking at different stocks and indices as well, the main drivers, the key drivers in stocks and how beneficial they are as well, and what we can learn from stocks, because stocks are looking a little bit more buoyant in 2022. We are looking at a lot more, especially the US stocks. We have had record earnings season as well for a lot of the stocks, and this is a really big driver for a lot of the share price. And money management and trading psychology, just to cap off the rest of the week. We look at trading psychology every day because trading psychology plays with your emotions, plays with emotional traders, and that's something we want to extract from our traders to give them the best possible benefits for trading and what to look out for. A lot of psychological trading books and webinars that there are out there, they do say that 80% is thinking about trade and 20% is actually trading. So with that being said, we just look into more in-depth reasons on where things can go wrong and where things can go right in trading as well. So look out for my introductory videos as well. I'm explaining a lot more on what is coming up for the weekly webinars. As I said, this is the first in a big series of webinars that we want to give to our clients and potential clients that are worried about trading and that they all honestly just want to get back to basics and to learn as much as possible. So this won't be the last one for basic trading. We'll be doing more and more of these to get traders more comfortable. And as I said, any subjects or any webinars that you want me to cover, be sure to drop me a message at any time, and we'll be able to discuss and go through anything like that. So in closing, thank you very much for joining me on this webinar today, and we'll speak again very soon. Bye for now and best of luck. Have a great day ahead. Bye for now.